Good afternoon, everyone. Is my voice clear and are you able to hear me very clearly? Thank you. Thank you, Safa. Thank you so much.
هيقول مين 1-0
في مساعدة 1-0 مكتوب أرجنتين.
I asked you.
Thank you, Esra, for joining in on camera. Thank you so much. Munira, can I start? Yeah, I think it's yeah. So good afternoon, everyone, once again, and welcome to this webinar on capital market regulatory environment in Bahrain. If I'm not wrong, most of you are representing the financial sector. And welcome to those who are from the financial sector, non-financial sector, investors in the seminar. Welcome to this webinar, which will be for around 45 minutes. I'll be giving my talks. And then we'll have the floor open for question and answers. And question and answers, as usual, are always welcome. I'll be more than happy to answer question and answers. So we are going to talk about the capital market regulatory environment in Bahrain for today. So before I start, let me give a brief introduction of myself. My name is Savita Raghavan, as you can see on the slide. I've been in, I've started my career as a banker. I started my career in capital market division of a bank, worked there, and then I moved on to work with PwC Bahrain. And then currently I'm a senior lecturer with the Bahrain Institute of Banking and Finance in the Banking and Accounting Center. And I've been with BIBF for the past 11 years. And I train in the area of regulatory and financial crime compliance. So that is me for you. That is a brief introduction of myself. So let's go straight to the topic about capital market regulatory environment in Bahrain. So as usual, we always need to put in the learning outcomes before we start any session. So what will you gain out of this 1 hour session? You will be able to discuss the importance of capital market regulations. We'll be able to discuss the capital market regulatory structure in Bahrain. And then we will understand what is market abuse. Basically, what this session intends to do is define what is regulation, and then make you understand why regulations, why capital markets need to be regulated, and what can go wrong. Yeah. So, and what does the regulator do to prevent these wrongs or mitigate these wrongs? That's something we'll be discussing over the course of this seminar. Meanwhile, if you do have questions, you can always post in the chat box or keep it till the last. Welcome. So let me ask you some questions. I'll be more than happy to have your answers. So who do you think is the regulator of the capital market sector in Bahrain? The Central Bank of Bahrain. Thank you so much, Muhammad. Muhannad, thank you so much and welcome. Yes, Amira, it is the Central Bank of Bahrain. Absolutely. So we have a single regulatory structure. So we have the Central Bank of Bahrain. Absolutely, Safa, the Central Bank of Bahrain. Beautiful. Thank you so much, my friends. Thank you very much. Thank you, Muhammad. Which volume do you think regulates the capital market entities? So as you all know, we have the rule book, CBB rule book, and we have 7 volumes as part of the rule book. So which particular volume do you think regulates the capital markets? Volume 6, absolutely, Abdul Wahab. Thank you so much. It's volume 6, which regulates the capital markets. And we have a volume 7, which regulates the collective investment undertakings, or CIUs, as you may call it. So absolutely, volume 6 regulates the capital market entities. Thank you so much. That's a wonderful answer, and thank you for participating. Well, this is a next question. Why do you think capital markets should be regulated? Why do you think capital markets should be regulated? Well, you may answer saying that that's why we are in the webinar. Protecting consumers, beautiful, Amira, well said. Protecting public interest. Wow, that's a good point, Mohammed. Absolutely. That's one of the reasons why we are going to discuss today. Why should capital markets for protection of investors and public interest? Absolutely, Ritesh, well said. Protecting the economy. Yes, absolutely. Preventing systemic risk is absolutely very, very well answered. Well answered, my friend. Absolutely. Well answered. And that's why capital markets should be regulated. So let's go into much more detail. So today's discussion will be around these 4 topics: importance of capital market regulations. What are the regulatory objectives? Now, that is one question which we'll be answering today. What is the relationship between regulatory objectives and regulations? Right? So basically, when we talk about regulations, regulations are created in order to prevent the regulatory objective from failing. So basically, the regulators have certain objectives, and the regulations are towards mitigating any risk towards those objectives, right? So they license entities and they want to mitigate the risk of these licensees doing something which will be a risk to the objectives. We call it RTOs, or risk to objectives. We'll be discussing that in more detail. And then we'll be talking about the capital market regulation in Bahrain. And lastly, we will end with market abuse practices. What are the certain practices which constitute market abuse? So that is what we are going to discuss. Okay. First and foremost, let me start with what are regulations before moving to what is capital market regulation. Now, let me start with our traffic regulations. For example, we have regulations in Bahrain wherein we are not supposed to talk on the mobile while driving. Obviously, we shouldn't be jumping the red signal. We should not be parking in a no parking zone, etc. These are some of the regulations. Definitely, these are rules we need to follow. But what do you think makes us follow these rules? What do you think makes us follow these rules? Anyone? Okay, the fact that penalties, absolutely, Safa, well answered, my dear. The fact that if I jump a signal, I'll be subject to a penalty. If I park in a no parking zone, I'll be subject to a penalty, right? Accidents, absolutely, that's one of the things. But I'm more worried about the penalty that I will be faced. Probably my license may be withdrawn. So these penalties make me careful. See, there are 2 things, right? One is the regulator is monitoring by putting in cameras, isn't it? So that I don't break the rules. The second point is, yes, if I do break the rule, I'm subject to a penalty. That is how any regulations operate. So coming back to our capital market regulations, what are regulations? Regulations are rules or norms adopted by any regulatory body and backed by a threat of a negative consequence. That's important. So what is the threat? You will be penalized. If you jump signal, you have to pay a fine. If you have a subsequent history of accidents, we may take away your license to drive. So these are the threat of negative consequences. Similarly, we have, even in the capital market regulatory sector, we also have a regulation and a threat of a negative consequences if you do not follow the regulations. And this, my friends, is called enforcement. So when we talk about regulations, we have 4 steps. Authorization, so which means the regulator licenses or authorizes an entity. Then standard setting, they put in the regulations. Supervision, the supervisors, they monitor us. That's why our reporting, etc. is done. And then finally, if you don't follow any of this, then there is enforcement. That, my friends, is regulations for you, right? So why capital market regulation? So we understood what is a regulation, right? Now, why should we have regulations for the capital markets? So the first one, if you see on the screen, it says to address asymmetries of information. Now, what is this asymmetry of information? Now, let's assume that we are going to buy a white good. For example, we are going to buy a washing machine or a fridge or any other white good for that matter. We go, we can see the physical asset. We can probably ask for a demonstration, right? We can compare between multiple for example, multiple refrigerators. We can see the quantity, we can see how much is the, what is the cooling effect, etc. And then we select based on our understanding of the. I'm so sorry, I think I muted myself. Where did you lose me?
It was just momentary.
It
Not
was
for
just
long.
momentary. Okay, okay, thank you. Thank you so much. So again, I was just talking about if you're going to buy goods for example, you're going to buy a refrigerator or a washing machine, etc. You can see the goods, you can compare it with other goods, you can ask for a demonstration, and you can even take there is a warranty, there is a guarantee that comes along with this white goods. But let's take another scenario. Let's say you're buying a financial instrument, a share or a bond, yeah, or a derivative. What is it that you're buying? It's not a physical asset that you're buying. And can you see it? Can you are relying on a third party for the information. Am I right? Let's say an entity comes out with an initial public offering, an IPO. You're subscribing to the share. When you're subscribing to the share, you are depending a lot on the prospectus that is issued by the issuer. Am I right? And who issues the prospectus? Of course, it is a merchant banker, but at the same time, the information is given by the issuer. So you're relying on the information given by the issuer. And is it in the interest of the issuer that you subscribe to the shares? Absolutely, isn't it? It is the interest of the issuer that you subscribe for the shares. So absolutely, the issuer is going to give you information which will make you purchase the shares. So you as an investor, you are not aware of what exactly is happening. You are just relying on a document that has been issued by the issuer. Right? So that, my friends, is called the asymmetry of information. So when the issuer has an interest, so that is why, and it is the information he knows. You are an investor, you don't know information, but you're relying on the prospectus, and that is why you would be subscribing to the share. So that is a asymmetry of information. So where does the regulator come into the picture here? So where the regulator comes into the picture is when the prospectus is issued, there are certain do's and don'ts. There are certain responsibilities and accountabilities. Right? So that is where the regulator is putting in a regulation to bring down this asymmetry of information. That is why we need regulations in the capital markets. I hope I'm clear, my friends. So asymmetry of information is the asymmetry between a well-informed or a party having an interest against a person who doesn't have, I mean, he has an interest in the investment, but may not have the information and the knowledge about the risk of that investment. That is called asymmetry of information. So capital market regulations addresses the asymmetry of information between issuers and investors. Right? So that's the first point, issuers and investors. And then clients and financial intermediaries. Again, the same thing applies. When, let's say, I go to a financial intermediary to, again, let's say a financial advisor is advising me on an investment. Again, I may not be as well informed as a financial advisor. I may not be as well informed as a financial intermediary. I again rely on what they are saying. I trust them. Two things, my friends. Basically, it is a matter of trust. It is a matter of fiduciary relationship. So I trust them to do what is good for me. So again, there can be an asymmetry of information, and that is where the regulator steps in and says that there are certain things which you can do, there are certain things which you can't do, which is what we are going to discuss as we move forward. And then between counterparties to transactions. The next one is to ensure smooth functioning of trading, clearing, and settlement. So I need to be sure if I'm buying shares, I need the shares in my account. If I'm selling shares, I need the funds in my account. So I need to ensure that the trade is settled, right? So how do I ensure? I ensure I can't as an investor. So I ensure that I deal in a licensed entity, and the licensed entity is supposed to adhere to the regulations, which ensures that there is a smooth functioning of trading, clearing, and settlement. And why do you need all this? Why do you need all this? End of the day, capital market is the backbone of an economy. And investors are the backbone of the capital markets. So investors have a very important role. If I as an investor doesn't have confidence, then I will not invest. So it is very important for the capital market to create that confidence for the investors in the market, so that I am more than happy to put in my money into the capital markets. So I hope the concept of why capital market regulations is very clear. So this is basically to avoid asymmetries, to ensure smooth functioning of the markets, trading, settling, etc., and to foster confidence. Two main things, my friends: trust and transparency. So irrespective of what it is, transparency, everything should be transparent. Trust, mutual trust. I should be able to trust my the financial sector to ensure to be sure that I would be getting what I okay, I hope it's clear. Okay. Now, moving on. Merit-based versus disclosure-based. I just talked about transparency, right? So when I talk about transparency, this is what it says: disclosure-based regime. Let me talk about it. Now, does the regulator tell you what is risky for you, what is not risky for you? Yes. For example, in Bahrain, we have investor classification. Investors are classified into retail investors, accredited investors, and ultra high net worth investors. We have classification, and also the CBB says certain products should not be issued to retail investors. Certain products are exclusively for the ultra high net worth investors, and certain products are for accredited investors and ultra high net worth investors. So that's what the Central Bank of Bahrain does say. But the fact is, the regulator does not take the role of determining whether or not it is too risky for the investor. That is left to the financial intermediary. That is based on a report which is prepared by the financial intermediary on your risk appetite and your risk tolerance. Suitability, we call it suitability, right? So that is a decision to be made by the investor based on my risk appetite and based on my discussion with the financial intermediary. But the regulator's role is to ensure that you as an investor or I as an investor are given full, timely, and accurate information to enable me to make informed decision. That is the role of the regulator, not to decide whether this is risky for you, this is not risky for you. No, the regulator is there to ensure that you as an investor get all the information. That is what is transparency and disclosures. Full timely. It should be timely, not too late, and accurate information to enable them to make informed decisions. So disclosure obligations are imposed on issuers both at the time of authorization and also on a continuous basis. There are a lot of disclosures, financial disclosures and non-financial disclosures, which a listed entity needs to do on an ongoing basis, on a periodic basis. So why? Because that is what the regulator wants in terms of continuous monitoring, transparency, and disclosure. These are part of the corporate governance principles as well. Right? I hope this slide is absolutely clear, my friends. So let's move on to the next slide. So as we were discussing, so we started off with why regulation. What are regulations? Why regulations? Now we move on to the next part, which is what are the objectives of regulations? Again, why should you know, why should you or I know the objectives of capital market regulation? The reason is when the regulator sets up the regulatory objectives, they want to ensure that, see, they are the ones who are authorizing the entities, right? The capital market entities are authorized by the regulator. Now, when they are authorizing it or licensing it, the first thing they would see is what is the risk of this entity to my objectives. So the regulator will check the risk of the licensed entities to the regulatory objectives, and based on that, they are going to issue the regulations. You understand? So that is why as a regulated entity also, as a regulated entity, I need to know the objectives because my policies and procedures should be aligned to the regulatory objectives. So what are the regulatory objectives? Investor protection, as you all rightly said, ensuring markets are fair, efficient, and transparent. This is what we talked about, transparency and trust, fair. And then protecting the integrity of the market. So these are the three regulatory objectives. Now, my friends, any threat to these objectives will be a regulatory issue, will be a regulatory breach. This is where the regulator will step in to enforce. So can you give me some examples of what can be a threat to these regulatory objectives? Anyone, any one example. What do you think can be a threat to these regulatory objectives? Okay. Well, let me answer the question for you. The first one can be, so that is what is this title of the slide, objectives of capital markets and the threats. The first one you can see on your slide is insider trading. Okay. Why is insider trading a threat to the regulatory objective? So let us first understand. I'm sure many of you would know, but for those of you who do not know what is insider trading, let me first explain the concept in brief. Let's say that I am a director in a bank in a country or in Bahrain. Okay. Now, in the course of the board meeting, there is a discussion that the board has made fantastic profits and a dividend is going to be declared, right? So this information I acquired because I'm a director and I'm sitting in the board meeting. So is this private information? Yes. It is non-public. Does the public know about this information? No. Is this material to the company? Absolutely. Is it price sensitive? Does it influence the price of the shares? Absolutely, it does, right? So now with all these, so it is non-public, private, material, and is price sensitive. Such information is called inside information. Right? So now As a director, I am privy to this inside information. So this inside information, I am taking it. And let's say I meet a friend on the way, and I just, in the course of discussion, I am so happy that I just revealed to the friend that, you know what, we have made good profits and we are going to declare a dividend. So that's just as a matter of discussion, I'm revealing this to my friend. Now, my friend takes this and goes and buys shares of the bank, right? Now, what is this? This is called insider trading. Because again, the trading was based on an information given to the friend, right? Based on private, non-public information, which is material and which is sensitive, which has a material impact on the price of the shares, right? Now, this is called insider trading. Now, as insider trading, why should, is it a crime? Is it illegal? Is it illegal to do insider trading? Anyone? Absolutely, it is. Yeah, insider trading is a crime. Now, why is it a crime? See, when you talk about a crime, you should have a victim, right? But in this case, who is the victim? I'm a director. I made a revelation. My friend got hold of the information and went and purchased the shares. So what went wrong here? Who is the victim? So why is it a crime? Why? Exactly, Safa. So why is it a crime? Who is the victim? Thank you, Safa, for responding. The reason is, there may be multiple players in the capital market. There may be multiple investors in the capital markets who may be selling the shares at the same time that my friend is purchasing. Now, these sellers, if they have the same information about the dividend, are they going to sell the shares? No, absolutely not. They would not be selling the shares, right? If they have the same information as me, you would not, the other investors would not be selling the shares. So that again, my friend, relating back to the asymmetry of information, was there an asymmetry of information between me, between my friend to whom I gave the information and the other investors who sold without having the same information? And because of the asymmetry of information, there was an adverse selection. That is, the people who sold, the investors who sold the shares made a wrong decision. You understand? So if they had the same information as me, they would not have sold. So because of the asymmetry of information, the fact that they made a wrong decision will impact the regulatory objectives. How? Because you are not giving a level playing field to your investors. Right? Because one investor is able to have some information because of their position or whatever, whereas the other investors are not able to have the same amount of information. So that is why the regulator steps in and says this is not allowed. So if this continues, what happens? Investors lose their confidence in the markets. And is that a risk to the objective? Will it impact the regulatory objective? Yes. So that is why the regulator steps in and says, no insider trading. Insider trading is a crime. Give us a report of your key persons. Make a list of your insiders. Yeah, these are all the regulatory reactions to ensure that insider trading is not happening, because insider trading leads to asymmetry, is basically an asymmetry of information, leading to adverse selection, leading to the investors losing their confidence in the capital market. So they lose their confidence, as a result of which they are not going to invest, which will again be a negative impact on the markets. That is why insider trading is a threat to the capital market. Okay, hope I'm clear on the first. So that is why we have regulations against insider trading. The next point you see on the slide is something called mis-selling. Again, a very interesting concept. What is mis-selling? See, mis-selling is selling a product to a customer or an investor, not because the investor wants it, but because you want to sell it. Now, what is this? What am I talking about? Now, my friends, as an employee of a financial institution or as an employee of a financial intermediary, we have something called targets, right? So sometimes we end up selling a product or a financial instrument to a customer because we want to sell it to the customer, because we want to meet our targets. And that, my friends, is mis-selling, because you are selling the product to the customer, fair enough, but that the customer really need it? Is it suitable to the customer? So that is something what is called mis-selling. And again, mis-selling is asymmetry of information, because I know the reason why I'm selling it to you. I'm selling it to you because I have targets to meet. If I meet my targets, I'm going to get my incentives. So that is why I'm selling it to you. I'm not bothered that you as a customer or an investor may or may not need it. So that, my friends, is mis-selling. Now, how does the regulator react to this mis-selling? The regulator reacts by saying that mis-selling again will be a breach of regulations. For example, we have the BC module wherein the CBB says that if the product is not suitable to the customer, if the product was not the choice of the customer, then the customer can definitely bring about a complaint saying that he or she has been missold. Right? So that mis-selling is again asymmetry of information between the well-informed expert, the banker or the financial intermediary employee, and the investor. So if you look at the slide, I've said something called conduct risk. Now, this is a risk that emerges if you missell a product. What is conduct risk? Conduct risk is the risk which emanates from a financial sector employee or financial institution doing an action which causes detriment to the investor. So if you do anything which causes harm, now it need not be financial loss. It need not necessarily be a financial loss, but even otherwise, if you do something which is detrimental to the interest of your investors or your customer, that can materialize into a conduct risk. Right? So mis-selling can lead to conduct risk. So again, this can be enforcement action. This can materialize into a regulatory risk. And that is why the regulator is stepping in and saying no mis-selling. Right? So what can mis-selling do? Mis-selling again leads to loss of faith by the investor or loss of confidence by the investor in the capital markets. So that is why anything which is a threat to the regulatory objective, the regulator says you should not be doing it. If you see the smaller frame, there's a terming called framing in the frame. Now, what is that framing? Framing is basically when customers or investors make a poor choice because the way you put it across to them. See, just as an example, sometimes insurance products are sold as investment products, right? What do you take advantage of? You take advantage of the fact that the customer or the investor may have a poor risk tolerance. So you take that loss aversion thing into account, and then you try to sell them a product which is not suitable for them. But why are you selling it to them? Because probably you're making a better commission out of it. So that again is where the regulator steps in and says no insider trading, no mis-selling. I hope everything is clear. Let me know. So far, so good. I'll just move on if you're all clear about it. So the next one is pump and dump scheme. It's just an example. Ideally, it should be market manipulation. Anything that leads to market manipulation is again something which the regulator will say, sorry, you should not be doing this. So what is a pump and dump scheme? A pump and dump scheme is probably a set of brokers forming a cartel and buying shares of a entity which is not that traded. And then when they keep buying, the share prices go up, 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 up. So when the share prices are moving not because of anything else, but because these cartel of brokers are buying it, they advise their customers to buy it. So the customers see that, wow, the prices are actually going up. So why don't we invest? So they also buy these shares, and as a result of which it goes further up. And when it goes further up, the cartel of brokers, they sell it, that is they dump it, as a result of which they make their profits, but the investors end up making losses. So is this a manipulation of the market? Yes. Again, because you know the market well. Is it information asymmetry? Yes, because the brokers are there in the market day in and day out. They know the market well, and that is how they are able to take advantage of their expertise. So that again is a market manipulation, is something which is a threat to the regulatory objective. So the regulator says no market manipulation. Right? And the last one is a Ponzi scheme. Now, let me explain what is a Ponzi scheme. I'm sure most of you would know, but just to bring out the difference between insider trading, mis-selling, pump and dump, and Ponzi. So here I would also explain the concept of caveat emptor, some new concept which is called caveat emptor, it's not a new concept, it's a concept which means buyers be aware. So if you are an investor, you should be aware. I'll talk about it. Now, what is a Ponzi scheme? A Ponzi scheme is where, for example, I would come to you and say that if you invest around, I said, for example, $1,000 with me, I would probably give you a return of 10% or 15%. But I would also put a condition saying that I would give you this return provided you bring in 2 more new investors. So what am I doing? All I'm doing is I am paying off my old investors with funds from new investors. As simple as that. So this, my friends, is called a Ponzi scheme. Now, is Ponzi scheme illegal? Yes, it is illegal. But what is the difference between Ponzi scheme and insider trading? Now, in Ponzi scheme, the regulator has said in so many words that it is illegal. You see, the concept is, before I invest in a Ponzi scheme, I need to do my basic due diligence. I need to understand whether the entity which or the individual is who is selling this is licensed to do so. Has the authorization to do so. Is he authorized by the regulator in Bahrain to sell this? Are you able to see the screen and the slides, everyone? Okay, great. Thank you. Because I just saw someone else took over control. So that's the reason why. Yeah, thank you. Thank you, Malini. Thank you, Safa. So coming back, thank you, Marwa. So coming back to the caveat emptor, I as an investor, yes, the regulator is going to protect me, fair enough. But then I as an investor need to do my basic due diligence, at least to the extent of inquiring whether the person, individual or entity who is selling me a product is authorized to do so. That, my friends, is the concept of caveat emptor. Buyers, be aware. Be aware of what you're buying. Be aware of where you're investing. Be aware of the risk of your investment. Yeah, the slides disappeared. I don't know why. Let me try to upload the slides once again. Yeah. Yeah, okay. I have no idea why the slides disappeared. Yeah. So So coming back, so this is where, so I was, so I hope the concept of caveat emptor is absolutely clear, my friends. So the thing is, yes, the regulator is going to protect me from asymmetries, is going to protect me from mis-selling, from insider trading. But when it comes to investing, I should know where I stand as well. So that is the concept of caveat emptor. Right? So now let's go to the regulations in Bahrain. So we have discussed why regulations, why capital market regulation. Now we are going to regulations in Bahrain, right? So volume 6, as you all rightly said, is a volume which regulates the capital market entities. This is classified into institutions, market standards, ongoing obligations, high-level standards, and dispute resolution and investor protection. So if you go further into it, under institutions, you have the markets and exchanges, which talks about the Bahrain boards, it talks about the CSD, etc. The second one, the clearing, settlement and depository, market intermediaries and representatives, and it talks about the crypto asset licensees as well. So this is the talks about institutions. And then we have the market standards. Remember in the first slide when I talked about prospectus, as I said, the issuer is in control of the prospectus. The issuer issues the prospectus with the lead arranger, and so they know what goes into it. But at the same time, the offering of securities or the OFS module tells the issuer what they can put in, what they should not be putting in, where is their responsibility, what is their liability, what is their accountability, is covered in the offering of securities module. So they when they issue the prospectus, it should be in line with the regulatory requirements so that the asymmetry doesn't happen. Then the second one is takeovers, mergers and acquisitions, prohibition of market abuse and manipulation. This is, we talked about market abuse, certain market abuses. We'll talk about it a bit more. We talked about insider trading, we talked about mis-selling, we talked about conduct risk, we talked about Ponzi's, and we also talked about there is one more issue we talked about, right? So now market surveillance and investigation and enforcement. As I said in the beginning, most important is authorization, yes. Standard setting, yes. Monitoring, supervision. This is what? Surveillance, investigation, and finally the enforcement. And then it talks about AML and financial crime. And lastly, the training and competency. So who can be the control persons? Who can be approved to be the control persons? Who are the material risk takers? Who can be material risk takers? What are the training requirements? All this is covered in the market standards volume. Then there are others. HC, high-level controls. It covers a lot of concepts on corporate governance. Tone at the top. It's very important for the tone at the top to talk about compliance with regulations. So disclosures and transparency, a very important aspect. The shareholders' rights, stakeholders' rights, minority rights, all these are very important in a capital market environment. So all these are covered in the high-level controls, and which covers the corporate governance code in Bahrain, right? And then we have the dispute resolution, arbitration and disciplinary proceedings, and then the international cooperation and exchange of information, basically for the pre and post-trade transparencies, etc. Then we have the Bahrain Bourse regulations. Bahrain Bourse is not a regulator, it's a self-regulated entity, SRO, but they have a set of regulations for their members, etc. Trading rules and procedures, clearing, settlement and central depository and registry rules and procedures, market rules, which governs membership, trading, supervision, arbitration among their own members, right? The Bahrain Bourse members, Bahrain investment market rules and listing rules. In addition, they have a lot of resolutions as well. Okay, some relevant extracts from the prohibition of market abuse and manipulation module. So the first one is insider. Insider means any person who has obtained inside information by virtue of his employment or profession, being an officer or shareholder of the issuer of securities, through illegal means. Now, is it all? No, this is not exhaustive. The fact is, any person can be an insider if he is aware that such information is confidential and non-public and he is trading or passing on the information to another party. So that, my friends, is the definition of insiders. Some more just for us to understand. So for example, no person shall directly or indirectly engage or encourage others to engage in any behavior that gives a false or misleading information. This is what I said, pump and dump scheme. What happens in a pump and dump scheme? I'm giving a misleading information to the investor saying that the share prices are going up, wherein I myself am buying it to push the prices up. So that is a misleading. So that is an example. Similarly, no person shall indulge in buying or selling securities before in advance of an order. So a client is placing an order. So you see the client placing an order and you buy it for yourself before buying it for your customer, or you sell it yourself before you sell it for your client. That is called front running. Again, that is an example of market abuse. Similarly, tailgating. For example, if an informed customer does a transaction, immediately you as a broker or as a financial intermediary do the same action, then that is tailgating. Similarly, the last one, no person shall encourage clients to deal in securities solely with the object of enhancing their own commission. This is what, my friends, I talked about mis-selling and conduct risk. This is where I sell not because I want the investor to benefit, but because I am here to benefit. So basically, for my advantage, for my commissions, for my targets, I'm selling it to you. So this is mis-selling again. So these are some of the market abuse practice which the CBB has set out in its regulations, so that we know for sure that these are illegal. So any of this act, if done, can lead to a negative consequences, which is basically the enforcement. So let us see some examples of enforcement in Bahrain. So we can see that this is an extract from the Compliance and Enforcement Annual Report of the CBB. So if you see, there are a list of companies which have done contraventions. So some of them are not reporting on time. Some of them is not informing the CBB about changes in senior management or board. These are some of the issues which you see on the screen. And what enforcement actions that have been taken is, if you look at the extreme right corner, it says formal warning, right? In certain, it's just sometimes it's a non-compliance letter, formal warning again, and then it is a formal warning, non-compliance letter, and per diem. So basically, how does the enforcement work? A private censure, public censure, and then they can put a penalty, financial penalty on a per diem basis. So these are some of the enforcement methods if an entity does not adhere to the capital market regulations. So my friends, I'm sorry, I think I took 3 minutes extra. So this is the crux of why capital market regulations. What are capital market regulations? Why capital market regulations? What is market abuse, and why regulations are designed in such a way to prevent market abuse and protect the investors. Any time for questions? Any questions? Thank you, Suad. Thank you so much. So, okay. So no questions. Thank you. So let me know if you do have any questions. More than happy to take the questions. Absolutely, Ritesh. But again, to see regulations, for example, if you want to access the regulations, they're easily accessible. Okay, by the way, if you go to the website, for example, CBB website, all the regulations are very transparently available. Go to the website. If you go to volume 6, you can see exactly what the regulations are. And CBB, along with Bahrain Bourse, is creating a lot of investor awareness sessions. So this is definitely, you can participate in this investor awareness session. And this webinar is one of them to help you be aware of the regulations as well. Yeah. So to answer your question, Ritesh. Thank you, Mohammed. I'm happy. Thank you. Definitely, I will share Isra. I think we will be sharing the slides as well with the participants, definitely. Thank you, Marwa. Nice of you. Thank you so much, Hussein. Thank you very much. Let me know if you have any further questions. Thank you, Fatima. Thank you, Isra. Thank you so much, Isra, for being on camera. Thank you very much. Thank you, Malini. Thank you, Amel. Thank you so much. Thank you, Ritesh. Thank you very much. Nice of you to say that. Thank you very much. Just mail BIBF if you need any further information on the CBB regulations. We are more than happy to help. Thank you, Noor. Thank you so much.
Hi, Savita. How
Thank
are
you,
you?
Safa. Thank you so much.
Savita, can you hear us?
Thank you, Arif. No, I can't. Actually, it's very feeble. I'm unable to hear you. Thank you, Marwa. Thank you so much. Someone was talking on the mic. Who is it? Thank you so much, Marwa. Meet you in future classes. Absolutely. Hello. The voice was very feeble. I could hear you. Thank you, Razan. Good afternoon. Oh, okay. So it was only you or a lot of people from Bahrain Bourse attended? Like last time for the KYC? You have a team. Okay, okay. Thank you, Razan. So I hope it was good. It was a short session, 1 hour, but try to cover. Yes, Razan, go ahead. Yes, about tailgating. Yes, my dear. See, Razan, to answer your question, anything which is based on, see, as an informed customer, I may not want you to benefit out of an information as I have. See, the information is not publicly available. So anything which is not publicly available and which is used by a person or a market intermediary, because of his or her position as a market intermediary, becomes illegal, Razan. So that is why tailgating would be illegal. It's not everyone's information. It's not a level playing field. So anything which is not a level playing field would be illegal, my dear. Yeah, Razan, I hope I answered your question.
We put the OP at AMH that will be covered for emergency cases. And then we added work-related.
Razan, no, I'm not able to hear you if you're speaking. It's very feeble. Can you increase the volume of your the mic or computer? I'm so sorry. I'm absolutely unable to hear you. Okay, great. Thank you, Razan. Anyway, I'm available. My email ID is there with you. Anytime, just drop in a mail. I'm more than happy to answer you. Yeah, I can give you my email ID. So if need be, you can always drop a mail. And I'm more than happy to answer you, Razan. Yeah. So thank you, everyone. And any further questions, do let me know. Thank you, Safa. Thank you so much. Thank you, my dear.